A very good afternoon and warm welcome to all of you. I am CA Dipti Jain, moderator for today's session, and advisor GyaanStation welcomes you all in today's session of GyaanStation KBS. GyaanStation Knowledge Booster session will be conducted by GyaanStation every Thursday from 4 to 5:30 p.m. with the intent to update the knowledge, impact of various judgment, notifications, and recent amendments issued by the government to our professional brothers and sisters. In the busy life, we hardly find time to update ourselves. So, weekly 1 hour at KBS will act as a confidence booster in your day to day professional routine. This, in turn, will help you to deal with clients' requirement in an innovative way. So stay tuned with GyaanStation by joining its YouTube channel and Telegram channel, and do follow us on all the social media handles. We can proudly say that it's the 4th year of our EdTech platform, and we have received the award for our educational courses for professionals at BSc in the year 2022. Through GyaanStation, we are into corporate trainings, physical as well as online professional, educational, and skill development programs. We cater the professionals from diverse fields like CA, CS, CMA, HR training, MBAs, financial advisory trainings, and much more. You can also subscribe to our YouTube channel to watch the videos, webinar recordings you can find on our YouTube channel for the future references. So following that, today we have come up with an interesting topic, amendments in Schedule 3, CARO 2022-20 and the recent education order by CA Rama Ranganaiki ma'am. Ma'am, welcome to you. In today's session, we also have the gracious presence of Chairperson of Chhatrapati Sambhaji Branch, Aurangabad, CA Rupali Bothra ji. Ma'am, welcome you and congratulations for being elected as the chairperson of the branch. And we wish you a very, very successful tenure for this year. And I also recognize the presence of Ashish Tekwanani ji from Income Tax Bar Association, Gujarat. And I really thank sir for being always there with GyaanStation and supporting in all the ways possible. Welcome you, sir. And
thank you, ma'am. It's your efforts which make us learn something new on every Thursday and keep us updated also, and our members also updated. Thank you.
Thank you, sir. Thank you so much for your kind words. So for today's session, here are the key takeaways for all our participants. So please stay tuned for next 1.5 hours. The amendments in Schedule 3 of the Companies Act 2013, CARO 2020, implications of these amendments on professionals like statutory auditor and secretarial auditors, consequences of non-compliances, and a discussion on understanding of severity of non-compliances of recent adjudication orders. So this all points will be covered in today's session. So please be attentive and join till end. So first of all, coming on the formality, I request Rupali ji to, as our guest of honor, to please share her thoughts with our audience. Over to you, Rupali ji.
Yes, thank you, Dipti. Good afternoon, everyone, and welcome. And I'm actually here for the first time at the GyaanStation, and जो भी हमने दीप्ति जी से अभी सुना है, it's a wonderful initiative that she is taking to update the knowledge of all our members and fellow co-workers and fellow professionals जो खुद को update रख सकेंगे through these webinars and through these seminars. So wonderful initiative and great efforts taken by you, Dipti ji. And of course, wonderful speakers जिनको हम सुन सकेंगे. So thank you, speaker for the day, Rangnayaki ma'am. I would really love to be a part of this GyaanStation henceforth, and would definitely try to attend the maximum number of seminars that I could. Also, कुछ और तरीके से भी हम अगर जुड़ सके तो we'll definitely love to do that, Dipti ji. And thank you for inviting me today. Thanks a lot. Thank you very much.
Thank you, Rupali ji. Sure, we will venture for more sessions. And now I request Ashish ji, to please say a few words before we start.
Nothing, ma'am. Thank you so much once again. And as I said earlier, it's really a commendable job that you keep on asking the people to learn. Knowledge is wealth, and we are all going to learn today from ma'am. Thank you, ma'am, for being part of this. And it's our pleasure that we can have the latest knowledge from you. Thank you.
Thank you, Rama ma'am. So let's start with this today's session. Before she start, let me have the honor to introduce our today's learned speaker, Rama ma'am. And she is a very close to me and very good friend of mine, always a mentor and guide and go-to person for any queries I have. And here I take the privilege to welcome her on my platform, GyaanStation, and introduce her. So she is company secretary, chartered accountant, as well as cost accountant by profession. She is also the registered valuer, SFA, IBBI, registered insolvency professional, certified independent director, obtained certificate course from GST, and also attended leadership development program from IIM Ahmedabad. She is the 50th rank holder in ICWA Inter. And currently, she is in practice as partner at Ritu Ranganaika and Company Chartered Accountants in Navi Mumbai, specializing in FEMA, GST, valuation, and IP consultancy. She is the independent director on the board of National Plastic Industries Limited and visiting faculty at ITM Kharghar and NMIMS Kharghar. As far as her corporate experience is concerned, she is having vast and varied experience of more than 20 years in the field of working in corporate and in China, diverse sectors of retail, offshore survey, shipping, private equity, and print media. Before setting up her practice, she worked in various corporates like Oswal Group, RPG Food World, Eclom Group of companies, General Atlantic Partners, ILX Media Group, and ESG Group. Other than this, she also handled various senior level roles in above organizations and dealt with various aspects of business, including project implementation, fundraising, direct, indirect planning, and assessment, FEMA compliances, FIPB approval, group restructuring, and much, much more. And she is a regular speaker at various forums for startup. She's also a startup mentor, Rotarian, and she travel and stock market. She's also a stock market enthusiast, and she's a regular speaker at a CA Institute, CA Company Secretary Institute, as well as many other professional forums. With these words, ma'am, I welcome you in today's session, and I wish happy learning to all our participants. Over to you, ma'am.
Thank you so much, Dipti, for those really kind words. Thank you so much. Uh, Today we are here to discuss on a most spoken about topic today. Are you worried about income tax notices, GST notices? Are you worried more about your company now notices? Because the kind of notices we have been seeing in WhatsApp and other areas, we could see, for not quoting a SIN number or a DIN number or not having a registered office in place. All these things are having consequences today. Just give me, I'll put it in. So company law is something which was not given more importance than one it required. Maybe it has come to forefront, and the smallest of small lapses, which may not be that consequential in our opinion, are also being looked at the MCA in a very different way. And they have been sending the show cause notices and the adjudication notices are really concerning to a lot of professionals. What are the kind of issues which are coming up? We will discuss at the last stage of this today's program, wherein we talk about the adjudication notices. What kind of notices have come and what kind of penalties is being levied, we'll discuss for the later part. The initial discussion for today is, we are going to talk about the Schedule 3 amendments, which came in 2021, the new CARO reporting, which came in 2020, but got implemented much later, the new clauses in audit report, which ask for certain specific references, and the impact of all these amendments in our profession, whether we are practicing as a chartered accountant in certifying, signing an audit report, or be a company secretary certifying certain documents, how, or as a KMP, whether you are a CA, CMA, CS, or a legal professional, all of them, how it is going to affect us in preparing and signing the accounts. And for consultants, who are into consulting, if not into certification or audit, and how it is going to affect us today. Today, we are in a scenario wherein the data sharing, harnessing is being done very well by the Government of India. Any mismatch in one particular act, say, for example, if you find certain information in your 26 AS, which is not being recorded in your books of account, the kind of mismatch which comes up and the kind of notices we get and the kind of implication it goes to our institute in form of disciplinary action, we all are aware. So the smallest lapse on our side could take us to a lot of, other unwanted consequences. And today, knowledge is the only power we can have. And that's the only way we can, improve in our profession. So when we talk about, relevant chapters for accounts, books of accounts, auditors, the Companies Act very clearly talks about in Chapter 9 about the accounts of the company. 10 talks about audit and auditors. And the relevant schedules we have for depreciation is Schedule 2 and Schedule 3 for the way the financial statements are to be prepared. When we talk about Schedule 3, that is our basic mantra, or that is our basic Gita, Bible, Quran, whatever you call, for preparing a financial statement. Schedule 3 talks about the bare minimum requirement to be reported by an organization. If there are any requirement to be done more than what is there in Schedule 3 under a various act, then that also needs to be reported. And if there are, certain information are relevant from our side, management side, to give it to our shareholders or to the readers of the financial statement, those things have also to be presented. So Schedule 3 is the bare minimum requirement, and that is not the ultimate requirement. Again, when we are presenting the financial statement, even the Schedule 3 notes very clearly says there has to be a fine balance between too much of data, which is going to clutter the financial statement, with those important information, which is going to empower the readers of the financial statement to take certain decision making. So Schedule 3 has to be read by verbatim to verbatim and given effect to. End of the day, when we prepare a financial statement or when we read a financial statement, the ultimate gain, the underlying what we are discussing is substance over the form. So it is just not the form, the substance have to be looked at. I'm not getting into that, what is books, papers, books of account, financial year. I would just touch upon that if a newly incorporated a company, a financial year could be 15 months, whereas in the rest of the years, it's going to be 12 months. And AGM has to be conducted within 6 months from, maximum 9 months from the end of the financial year. The difference between two meetings should not be more than 15 months. And by 30th of September, we should have our AGM in place. For the first financial year, it could be 9 months. So accounts have to be audited, taken to the share, approved by the board. It should go to the shareholders to be approved in the AGM. And then the necessary forms have to be filed with MCA, whether it is AOC 4 or MGT 7 or 7A. Here we have to keep in mind the requirement of consolidated accounts also. There are organizations which has got subsidiaries, so they have got associate companies. Then the consolidation will also come into play. So the accounts with AOC 4 CFS is also to be filed with MCA. Today, the kind of notices we see in the MCA from the MCA side is people have not filed accounts for so many years, so many days of pending, non-filing. Then certain forms which needs to be filed in time or not filed. These are the cases. Generally, adjudication happens when we go voluntarily to go get the matters rectified, or there is an inspection from the MCA side, or there is a complaint from somebody. In that process, MCA does an inspection on our financial statement or our books of record, and they find non-compliances on our side. If I can quote 2-3 small errors where the adjudication has happened, is not quoting a SIN number on the letterhead of the company. not having email ID of the company or the mobile number or the telephone number of the company on the letterhead, these things could appear to be the smallest error. Why it needs for a penalty to be levied? The law says the organization has to be identified. The letterhead has to carry those information. If any of those information is missing, then the adjudication, the show cause notices could be issued and adjudication will happen. Whether we go it voluntarily and get it rectified our mistakes, or the department comes up on various occasions to us. When we talk about registered office, maintaining the registered office of the company at all business hours is a very mandatory. In fact, I will take you through one adjudication order which says, when a document was sent to a company by post, it could not be delivered at the registered office of the company. It got returned back to the post office. Then they tried to reach the company. It could not be delivered, and then went back to the registrar of companies. They started the entire consequence of actions for the company, saying that the law says a registered office have to be mentioned at all times during the business hours. So if it is not there, the registrar says you have done a violation of not maintaining the registered office. Then it takes in the adjudication order, what we will see, it takes further. If there is no registered office, then that means the statutory register of members, your other statutory registers are not maintained, the penalty for not maintaining in the registered office, all these things follows, and we have an adjudication order which where the penalty is in several lakhs. So the smallest error like this, possibly somebody could have had an office registered in their residential premises, and at some point in time when the registrar was trying to send a document to us, house was closed, the document was not received, the consequence of not having a registered office will come into play. So when we start about looking at the financial statements of the company, the basic applicability of various provisions of Companies Act have to be looked into. What are the restrictions? What are the limitations posed? Can a private limited company can take loan from anybody, everybody? Can we have deposits? All those implications should be understood before getting into a transaction. The basics, when I say the smallest, like an object of a company, which is not maintained, which is not there in the objective MOA of a company, the company doing that particular activity, that means the directors have exposed themselves to a personal liability, and the object not covered in the memorandum is not within the liability of the company. Company could always wash their hands saying that it is beyond ultra virus, and the directors are personally responsible for the activities taken. So the smallest thing as the memo A, what is the objective of the company? Is it matching with the business which is being conducted by the company? Needs to be checked. I have X objectives, but I'm doing Y objective. Such smallest error could also be under a lot of scrutiny and liabilities for respective people. I just spoke about the registered office. I spoke about the financial year, and I will talk about the auditor appointment. Auditor appointment is something which is the auditor is supposed to be a watchdog of the company. So there cannot be an occasion where we don't have an auditor. When an auditor, there is a casual vacancy because of death or whatsoever reason, resignation of an auditor, within next 30 days, the board has to, fill up the casual vacancy. We see a lot of cases where the auditor's appointment is happened for 1 year, 2 years, whereas in the 2013 Act, the first auditor is appointed till the first AGM end, and later on, auditor is appointed for a 5-year tenure at one point in time. So the ADT filing has to be for 5 years and not for short period. That needs to be checked. CSR provisions, these very, very important provisions, CSR provisions, whether they are being adhered to, where the company, CSR provision might look like, it is applicable for larger corporates. But if you look at the threshold for CSR activity, you can leave the capital, you can leave the turnover. But if you look at the profits, that is a slim margin. We talk about 5 crores. So anybody having a profit of 5 crores will be subject to CSR provisions. If those provisions are not fulfilled, if the transfer of money does not happen within time, then we have implications there. Similarly, loans taken by the company, whether they are within the powers of the company, whether the directors have taken it at a board meeting, in a conducted physical meeting, all those things needs to be seen. Non-compliance with any of these things could lead us to penal consequences. Similarly, related party transaction, the entire crux of, NPA, the entire crux of, what do you call, arm's length basis is to be seen at the related party transaction. There lies a huge area of importance for a professional to pay attention to find out whether those related party transactions are genuine business transactions, whether they have taken at arm's length basis. That is very important. Similarly, for public limited company, managerial remuneration is another area of important aspect to be checked by an auditor, whether it be a secretarial auditor or a statutory auditor, because under CARO 2020, the managerial remuneration clause has been taken out, and now it is fully a preview of a secretarial auditor. But having said that, if there is no secretarial auditor, the statutory auditor anyway has to check at the time of statutory audit of the company. So we all know the financial statement consists of profit and loss statement, balance sheet, notes to account, director's report, cash flow statement, and independent auditor's report. The auditor's report has consist of your CARO 2020 reporting, where it is applicable to a company, and the new Schedule 3 requirement, which is effective from 2021, is asked for a lot of information to be provided by the organization, the corporates, not necessarily the bigger ones, even the smaller ones. There is no exemption available for small companies not to disclose certain information. So Schedule 3 requirement has to be fulfilled verbatim to verbatim, and non-fulfillment of it, we have seen recently a lot of adjudication orders wherein, interest is not being given effect to while finalizing the financial statement, the auditor not commenting on it at the audit report. Similarly, expenditure above more than 1% or 1 lakh of rupees threshold, if those expenses are not disclosed separately by notes to account, it is required under Schedule 3. If it is not done, then there are consequences. We have recently seen last week an adjudication order levying a penalty of 1,50,000 rupees on a statutory auditor for not commenting on those lapses in Schedule 3. So we live in a world where the adjudication happens very faster. The penalties are being levied strongly, and we are exposed to a world of lot of unseen or not taken into account situation. So if you look at I'm not getting into the basic Schedule 3 requirement. I'm sure all of us have been doing for quite a long time. Let's look at the recent amendments. If you look at the amendments, the background in which these amendments have come in, it puts a lot of accountability on the management and on auditors. When the CARO 2020 came in, there were a lot of points wherein the auditor, statutory auditor was supposed to come in, wherein there was no reference of certain statements from the management. So to take away that anomaly, Schedule 3 was amended accordingly to give information from the management on certain aspects, and the auditor can apply the necessary test and controls on those statements and give their opinion at the CARO 2020 reporting. So there is going to be accountability, absolute accountability on the management and on the auditors. If you see the amendments per se, these have all come mostly from the IBC experience of our government. How the money has been taken away by the promoters, how NPAs have been done, where there were no early warning signs. So how to give early warning signs for the readers of the financial statement so that they can take necessary actions and information. Similarly, for more of transparency, the entire purpose of preparing a financial statement is transparency, the providing of data to the reader of the financial statement, so that transparency and disclosures become the bedrock for any corporate governance. And the changing needs of business, as we have seen, the country changing in the last 15-20 years, looking at the change in the need of the industry, the changes have been brought in. Last but not least, enhancing corporate compliances and corporate governance. If the Prime Minister has said in the floor of the Parliament, saying that, or the Finance Minister said in the floor of the Parliament, that this country compliance concept is very minimal. So they want to bring compliance. And if you see the way GST laws are taking place, the way FMA is taking place, the way income tax is now serving notices, you can see compliance is no more an option. It was never an option, but especially in the last few years, you can see non-compliance gives you immediate instant result. It's like a instant karma. You don't file your income tax return, notice comes immediately. There is a mismatch in your 26 AS to your income tax return, or your GST return to your income tax return, or to your audited financial statement. Instantly notice comes from various departments. So compliance and corporate governance is the base in which it has been discussed and given. Last but not the least, the more of governance and less of government. That's the approach, the mantra the government is trying to say. And we all know India wants to reach to 5 trillion economy. We want to bring the best of the investments in FDI. Looking at those background, these amendments have come in with the available data. It is like, a chore does something, then we tighten something. Another thing happens, it tightens. So now it has become so difficult that we are going to spend too many time in doing only compliance rather than doing business. This is where there is a real challenge for small and medium enterprises and small company in reporting of large amount of data when they don't have structure in place to get the data. So the expectation is too many disclosures in the account. With those disclosure, a reader of the financial statement, be it any stakeholder, an investor, a government authority, or an employee trying to join a company, or a vendor or a customer, all of them can understand and get early warning signs from the company to know whether they have to deal with this company or not. So I said CARO 2020 expected too many information from the auditor. There was no reference to in Schedule 3, and that has also been done. Now the challenge is, if we don't have a well set up infrastructure in place, collecting this data is going to be very difficult. It is all end of the day GIGO, garbage in, garbage out. If the data captured is not comprehensive, then reporting is not going to be comprehensive or accurate. We are going to spend many time, and as professionals, how we can save our time in getting the data as quick as possible and in the most accurate fashion is what is going to be the requirement of all of our people. So if we look at the Schedule 3 consists of 3 divisions. Division 1 for people following accounting standard. Division 2 is for people following Ind AS, and Division 3 is for NBFCs following Ind AS. So whenever we talk about the amendments in Schedule 3, it applicable to all the 3 divisions, except for in 2 and 3, what is specifically required. Along with that, whatever is given in Schedule Division 1 will apply to all of them. So the new applicability is from 1st April 21. So we have already taken out 22, 23, 2 balance sheets. So we are slightly comfortable in giving the data what is required under the new Schedule 3. So we have to read all of them in sync with 2 things. One is the CSE established by MCA. There is a central scrutiny center in MCA, wherein all the forms we are filing under MCA are read, and if they find any deficiency in the forms, it is sent to the respective registrar, and the registrar sends respective notices to the corporates, and then necessary action is being taken. So with CSE in place, before CSE was set in place, we didn't have many notices coming in because our documents were never picked up, or were picked up in a very random fashion, which was not regular. With CSE in place, now the form is getting thoroughly checked at professionals, and then if there is any deficiency, it is going back. In fact, to name you one example, in one of the adjudication orders, the order said that corresponding financial statement which was scanned and uploaded in the MCA portal was not legible, and the person signing that document, that is the director, and the professional certifying that document bear levied penalty, because if the document is not legible, how can a public download that document? How can a public scrutiny of that document happen? And the explanation given by the corporate was that there is a space constraint and we have to compress the document. And since we all file day in, day out these documents, we realize because of the space constraint, we have to compress the data and upload it. But unfortunately, the law enforcing authority says, whatever you do, I want a legible data. So how do we do it is going to be a major challenge. The space constraint, it is there. The requirement of a legible data is there. So these are the adjudication notices which bothers me as a professional, wherein there is no wrong intent on the part of the corporate or on the part of the professional. But these are genuine problems which as an industry we are grappling, and as penalty notices we could be facing, or some of us have already faced it. Plus, all these financial statements have to be understood in the context of NEFRA, wherein NEFRA is, we all know that they are reviewing the audit quality report for the listed companies, and they look at the financial statement from a quality review, that is financial report quality review report for the organization's report. So if you go to NEFRA's website, there are observations made by NEFRA on the audit quality. There is observation made by NEFRA on the financial statement quality. And those things also make you understand, if big fours can get into such kind of problem, what you and me as a small and medium practitioners are going to do, how we are going to grapple the situation. So these are the disciplinary actions for which we as an industry should be prepared if we don't take adequate precautions while signing the financial statement. And we all know the expectation of government department after newly implemented GST law. If they, after 5 years, the department will send you a notice, but on day one, we are expected to know what is there in the statement. So that is the quality or the level of expectation the regulators are having on us as professionals. So our responsibility is now multiplied like anything, and we have to roll up our sleeves and get prepared for the occasion. How we get prepared because of with advent of technology or with good quality manpower, it is all up to us to figure out. But end of the day, we have to own our signatures for whatever we are signing. So if you look at the amendments, rounding off is one thing which has become mandatory. Before this amendment, it was may, now it has become shall. So for people who are having less than 100 crores of total income, the rounding off has to be done in hundreds, thousands, lakhs, or millions, or or decimals thereof. But for people having 100 crore rupees or more, it should be rounded off from lakhs or and above, not below that. Because again, when I said reading of the financial statement, the statement should be easily read. So if we are going to give to the last decimals, if the reports are in larger numbers, reading becomes difficult, and so they want to give a rounded off numbers. Before in Schedule 3, we used to report only the shareholding of 5% more by anybody of shares held by the promoter. But the amendment is now asking for all promoter shareholdings to be reported. What was in the beginning of the year, what is at the end of the year. If there is any change in the percentage of the during the year, that needs to be reported. Promoter here means as defined under the Companies Act, and those promoters have to be, their shares have to be given for separately for each class of shares. And it is just not 5% anymore. It is to be the entire entire shareholding has to be disclosed, even if it is less than 5%. The another amendment which is there in the trade payables is, we had aging analysis for debtors, but now we have aging analysis for creditors also. Among creditors also, between MSME and others who are not MSME. Between them also, between MSME and others, how much of them are disputed dues and how much of them are disputed for MSME and how much of them are disputed for others. And we have to give in the age analysis of less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. When there is an aging analysis of more than 3 years, we have to understand Limitation Act sets in about 3 years. So if anything is reaching in the range of 3 years, it's an early warning sign for the organization to go and establish the claim if it was not done in the past. Similarly, IBC is never meant to be a recovery mechanism, but a lot of organizations try to use that as a recovery mechanism. And when it reached the NCLT, it was found that most of those payments are disputed and the cases had to be dismissed. A lot of time of NCLT has been spent on identifying those disputed or undisputed. Now, on the face of the financial statement, they want the organization to classify between disputed and undisputed, so that if there is any disputed payments, then that person cannot take you to IBC and waste the time of NCLT. So that is the impact of change in the giving an aging analysis for the creditors. Then this is only a technical correction. Before, current maturities of long-term borrowings were declared under long-term borrowings. Technically in our operating cycle, because whatever you have to classify in your financial statement, All of them have to be classified based on our operating cycle. Operating cycle for a business could be 60 days, somebody 80 days, somebody 360 days. Maybe for an organization like a real estate company, for a building company, it could be more than 1 year also. So anything which is to be paid or recovered within that operating cycle is supposed to be kept as current assets or current liability, and anything above that is supposed to be non-current. Similarly, if there is any current maturities of long-term borrowings, then they have to be disclosed under short-term borrowings and not long-term borrowings. So that was only a technical correction which was done to bring in parlance with the our general understanding of the subject. On the asset side, now our accounting standard now no more calls it fixed asset. It's called PPE, property, plant and equipment. That has to be distinguished between property, plant and equipment and intangibles. Then if there is any asset which is revalued above, even each classification of asset, each group of asset, if it's valued for more than 10% of the next carrying cost, then it has to be mentioned. And whether those valuations is done by a registered valuer under the Companies Act, whether it is being done or not is to be mentioned. So now under Companies Act, any valuation can be done only by a registered valuer. For plant and machinery, we have a certain class of valuer. For land and building, there is a class of valuer. And for financial assets, that is, SFA, we have a different class of valuer. So anybody who is a registered valuer, registered under IBBI, whether we have got it, valued from them has to be mentioned on the face of the financial statement. When we move to the accounts receivable, again, we had aging analysis before, but now they wanted detailed aging analysis of less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Now, when I say early warning sign, if as a reader of the financial statement, if I see the organization's payment, outstanding is more than 3 years, a large chunk of money, generally, you have to collect your receivables within your operating cycle. If it is pending for more than 3 years, are you in a position to collect them? Are they going to be written off over a period of time? So it makes me decide as a reader of the financial statement who's going to be a stakeholder associated or going to be associating to decide accordingly looking at the financial numbers. Between those numbers also receivables, undisputed and disputed have to be separately done. And out of them also how much is considered good and how much of them are considered doubtful needs to be very clearly mentioned. Again, when I spoke about MSME dues, even before the amendment has come under Companies Act, MSME Act wanted to disclose the payments due to MSME. So even before this amendment, we used to disclose it because I said Schedule 3 says if there is a requirement for reporting under any other act separately, then that needs to be reported irrespective of whether that is being said in Schedule 3 or not. So now MSME, if you do not report, in fact, the recent adjudication order, it was the same matter that the auditor has not commented on the, dues to the MSME. So now we have to, as an auditor, we have to look at the process in the organization, how they are recognizing MSME, whether they have got the disclosures, whether the data is captured in your accounting package the way it is, and whether the data presented to you is correctly as per the requirement of law. So there's going to be a lot of time spent even in a smallest item like outstanding due to MSMEs needs to be done, especially from this year when 43B also says this MSME dues are going to be looked at in a very, very detailed manner. Now, not only from Companies Act, even from income tax return per se also, right? When we have borrowings from banks and financial institutions, if there are any borrowings taken from banks and financial institutions, whether those funds are used for the purpose for which it is borrowed, if not used for the purpose, then for what it is being spent has to be mentioned. This is basically to take care of your diversion of funds. I take it for X purpose, I move it to promoters, I move it to Y activity, I move it to my subsidiary. So the reader of the financial statement, be a loan provider, would like to know whether the funds were used for the purpose for which it is being given. Similarly, in now the amendment made is title deeds of immovable properties not held in the name of the company. This is to be seen in the context of Benami property holding. This is to be seen in terms of Section Companies Act, wherein says the properties of the companies have to be in the name of the company. If they are not in the name of the company, then the reasons for not having in the name of the company, maybe the land mutation has not happened, whatever the reason has to be mentioned so that the reader of the financial statement will know so-and-so property held by the company are not in the name of the company. Similarly, I just said if there is a valuation in the fixed in the property, plant and equipment, then the how much is the valuation done, whether the valuation was done with the registered valuer has to be mentioned. Another important area where I said early warning sign. The loans or advances granted to directors and KMPs and other related parties. So the bifurcation has to be given, how much of loan is given, which are repayable on demand or without any specific terms or a period for repayment. So it is basically movement of funds from company to the promoter, director, KMPs or related party. So the fact has to be given, how much of the loan is outstanding. Not, it doesn't stop there. How much is the percentage of that in terms of overall percentage of the loans of the company? That needs to be mentioned. A very, very important piece of information for the reader of the financial statement. Similarly, capital work in progress. If you have any capital work in progress, then we have to give the age-wise analysis, and out of them also how much is in progress, how much is being temporarily suspended has to be mentioned. Then capital work in progress, then again, if there is any cost overruns or it has not been not matching with the initial plan, the project details have to be given and how much is being there. The same thing has to be done for intangible assets as well. When I talked about properties not in the name of the company, if there are any Benami proceedings initiated or pending against the company, then for any holding any Benami property, then the data has to be disclosed in the format given under the Schedule 3. The format is details of such property, in which year it was acquired, how much is the amount, who are the beneficiaries. If it is in the books of account, you have to reference it to your fixed asset schedule. If it is not in the books, then the fact has to be mentioned that it is not in the books of account and why it is not there in the books of account. Similarly, if there are any proceedings, the status of the same and the company's view on the same has to be mentioned. So as an auditor, we have to take in a lot of representation from the management, look at the background factors and then corroborate those evidences with the information given and derive at a conclusion and then comment on it in CARO by the statutory auditor. Correct? The borrowings, if the borrowings are secured by current assets, if the stock statement given to the banks is it matching with the books of account, if there are any material discrepancy, then that needs to be mentioned. So this is a very important early warning sign or a late warning sign for a bank or financial institutions to know whether the stock statement submitted to them is matching with their books of accounts of the company. And if the funds are not used for the purpose for which it is borrowed, then the details of that also needs to be mentioned. Again, if a company or the promoter of the company is being declared as a willful defaulter, then the fact has to be mentioned so that the reader of the financial statement will know that so-and-so promoter of this company or so-and-so director of this company is being declared a willful defaulter. Let the buyer be beware, so that you will be taking adequate cautions whether to deal with this company or not, or with this promoter or not. This is going to be a very, very painstaking effort for every organization, relationship with stock of companies. So if I have any receivables, if I have got any payables, if I have got any investments, if I have any investment in companies which are struck off or outstanding balances, I have to tell them how much of them are in those companies which are under struck off. So that means I am supposed to check each and every customer vendor of mine, whether they are under strike of companies. How do we do it? If they are a large corporate, maybe your SAP or ERP itself will go to MCA portal, do the verification and come back. Otherwise, you have to send declarations, get the declaration from the respective people, verify it in the MCA portal and do it. It's going to be a painstaking effort for an organization to do this. Similarly, any registration of charge or satisfaction of if the immovable, there is a question in the chat box. It says, if immovable property is in the name of the director, is it okay? The apparent answer is not okay, because Companies Act says no, the properties have to be in the name of the company, but for whatsoever reason, if it is in the name of the directors, then the fact has to be mentioned. And what is the stage in the transfer? But ultimately, those have to be transferred in the names of the company, right? So what is the situation needs to be mentioned there. Registration of charge or satisfaction of charge is a very, very important aspect which needs to be taken into consideration by every person in the organization. Many a times, registration of charge will happen in time because your banks and financial institution will ensure that it is signed it and taken it from you. But satisfaction may not happen. The bank will not give the, the discharge letter. We have to be behind the banks and financial institution, tell them the consequence of not filing in time and make them understand and get the documents in place. If they are not done in time, the fact has to be mentioned that if the charge creation or satisfaction is done beyond a specified statutory period of 30 days or whatever, if that has to be disclosed as a note to the accounts. The next is compliance with other laws and disclosure. If there are any schemes of arrangement, and if those accounting treatment for those schemes, whether it is being done properly, if there are any variations, then that has to be mentioned. If the company is invested beyond two layers of beyond 2 layers of company, then we have to mention which are those companies and why it has gone beyond 2 layers of investment. Last but not the least, we all know the financial ratios. What was used to be a job of an analyst is become a job of the organization and the auditors. The financial ratios are given. There are these are the ratios which are to be mentioned. The ratios are put up in the name of profitability, in the profitability ratio, of net profit ratio, return on capital employed, return on equity, return on investment, and on the liquidity side as the current ratio, and as a turnover side as a inventory turnover, receivables turnover, trade payables turnover, net capital turnover, and on the solvency, debt equity, and debt service coverage ratio. If it doesn't stop there, you have to explain what is there in the numerator and what is there in the denominator. So the explanation has to be given. Plus, if there is a plus or minus 25% movement in the ratio from last year to this year, then the reasoning for that plus or minus 25% has to be explained. If it is within 25%, nothing needs to be explained. If it is beyond that, a reason for a plus or a minus also needs to be explained, so that the reader of the financial statement will understand what was different in that particular year, so that the ratio has gone off whatever is the parameters which was there in the previous year. This is going to be a Herculean task explaining. The management has to have all their answers ready, because this is one of the way we, as a student of financial management, have understood how organizations can be compared between intercompany comparison or intra-company comparison. Now, with this information, every reader of financial statement will come to know something. See, financial ratios are only a barometer. It will say something 98.7 is a normal temperature. If it is above or below, something is not right. What is not right? Then people have to dig into the data to find out what is there. Another important note, which note percolates into main audit report, is if company has taken any money from any person with the instruction to give it to anybody else, then that fact has to be mentioned. It is not just the lending, it talks about guarantee and security also. So X gives it to Y with the instruction to give it to Z, then the fact has to be mentioned. So if it is received, and again, if the company has paid, so if company is giving it to X with the instruction to give it to Y, even that needs to be mentioned. And the auditor has to comment on it to say whether there was any such kind of utilization of funds. And the auditor also has to mention in the main audit report. It is not even in your CARO reporting. That comes in your main audit report. This is as far as Division 1 balance sheet items are concerned. When we come to P&L item, the word sales has been now changed to revenue from operations. Similarly, if it's a Section 8 company, if they have received any donation or grants from any authority, then that needs to be mentioned. Similarly, if the company has offered any income under voluntary disclosure scheme in the tax returns, whether the same is being mentioned, is surrendered in the P&L has to be mentioned. If it is not surrender also, the reason for not giving that in the financial statement has to be mentioned. I mentioned to you corporate social responsibility disclosure is a very important disclosure. So how much is the money to be spent, out of which how much is incurred, what was the shortfall at the end of the year, how much was the previous year shortfall, why there is a shortfall, what kind of CSR activities being done, the details of related party transaction on those CSR activity, movements in provision with respect to liability incurred into any contractual obligation, all those things have to be mentioned. And from last year, cryptocurrency has become talk of the town. So if the company has traded or invested in any cryptocurrency or virtual currency during a financial year, whatever is a profit or loss involved during the cryptocurrency or virtual currency has to be given. How much of cryptocurrency or virtual currency held at the reporting date is also to be mentioned. If the company has given any advances to any person for the purpose of trading or investing in cryptocurrency also, that also needs to be done, because Government of India wants to monitor them, because it becomes an avenue for investment without. So now we have TDS provisions and everything regulating cryptocurrency accordingly. This is as far as Division 1 of Schedule 3 is concerned. Whatever we have discussed so far, amendments will apply to Schedule 3, Division 2 also, plus whatever is going to be done. In case of Division 2 company, that is companies following Ind AS, now the lease liabilities is being added because of the Ind AS requirement that needs to be reported. Similarly, in the capital structure, in the equity capital structure, whatever was the opening and closing, along with these two red ones are the new amendments. If there are any changes in equity capital due to prior period errors, that needs to be reported separately. Similarly, if there are any restated balance at the beginning of the current reporting period, that also needs to be reported accordingly. That is the only thing. As far as trade receivable is concerned, Ind AS, measures receivables in a different way. So accordingly, the table has been drafted, like undisputed trade receivable considered good. Otherwise, your aging analysis same, 6 months, 6 months to 1 year, 1 to 2 years, 2 years, 3, and 3 years and above. Again, between disputed and undisputed, only difference is what is considered good, what is considered doubtful, and where there is a credit impaired payment is there, or where there is a significance in credit risk, that also needs to be reported separately. So this is for Division 2 is concerned. When we go to Division 3, these are NBFCs, may not be applicable to many of us. There are requirement as to maintenance a certain, capital adequacy ratio, liquidity coverage ratio. Those have to be mentioned, right? Any questions? If not, I'll proceed with CARO. So other matters in the audit report I just mentioned. If there are any loans or advances given with the instruction to give it to somebody, that needs to be done. Then whether the company has declared or paid in a dividend, if it's in compliance with Section 123 of Companies Act has to be mentioned. If they are not in compliance, then that needs to be reported. The audit trail which was kept on hold is applicable from this year. So from this year, audit trail also details have to be mentioned by the auditor in the audit report. I have already spoken about Central Scrutiny Center. So any mistake which happens in any of our reporting could have implication, and hence we need to be careful about whatever we report to the department, right? Let's go to CARO 2020. CARO 2020 is in replacement of CARO 2016. Now the CARO 2020 requirements, because when you go through the CARO report, it is like a certificate. They ask you specific questions and specific declaration as to certain information, wherein as a reader of financial statement, I would be able to appreciate what exactly is going in the organization. So CARO 2020 is in replacement of CARO 2016. Now it has got a quite detailed, but 21 clauses are there. Previously, there were 16 clauses. Now, 7 items are, it's a detail when 21 are there. Previously, there were 16 clauses. 7 are new clauses. 1 clause is already merged and 1 clause is deleted, which is basically on the managerial remuneration, which becomes part of secretarial auditor reporting. So, managerial reporting is remuneration is not to be reported under CARO 2020. Central government has issued it in consultation with NEFRA, then it replaces this one, and it is applicable for financial years commencing on or after 2019. So far, we have very comfortably reported in the last 2-3 years, so we understand most of them. But having said that, there are a lot of auditors who are still referring to CARO 2016 and giving reporting under that. So we have to be very, very vigilant about it, bring it to CARO 2020 and test them for the requirements accordingly. CARO 2020 is applicable even to foreign companies. Only thing is CARO 2020 is not applicable to consolidation of financial statement in the consolidated financial statement. But having said that, if at the consolidation, if the consolidated auditor is seeing any qualification under CARO 2020 by any of the auditors of the subsidiary or associate companies, then they have to pick those qualifications and put it in their main report saying that under so-and-so subsidiary, under so-and-so clause under CARO, so-and-so is the qualification made by the auditor. Because when we are picking and putting that, it is only a copy paste into our main report. The consolidated auditor is not supposed to apply any materiality thresholds on that. The way it is there, it has to be picked up and put it there so that the reader of the financial statement are able to appreciate in the CARO report of so-and-so subsidiaries or so-and-so enterprise, so-and-so is a qualification. So they are able to read it with that particular disclaimer. CARO 2020, as it was CARO 2016, is not applicable to banking company. It is not applicable to insurance company. It does not apply to even Section 8 company. It does not apply to OPCs. It does not apply to small companies. It does not apply to a private limited company, which is not a subsidiary or a holding of a public limited company, or if it has a share capital or reserves of more than 1 crore as on the balance sheet date, it is all the conditions have to be fulfilled. And not having a borrowings exceeding 1 crore rupees from any banks or financial institution at any point in time. Here it is covering only banks and financial institution, and it should not have more than 10 crores turnover. But having said that, if a company is a small company, then this point need not be considered, because our CA Institute guidance note very clearly says it is not applicable to small company. So even if those private limited conditions are not fulfilled, still CARO 2020 is not applicable to those companies. I just spoke about a small company. I spoke about basically the consolidation. And this is not, the order is applicable to branch office of a company also. It is not applicable to REIT and InvITs, right? While then what are the 21 clauses? The first clause talks about maintaining of records for property, plant and equipment and intangibles as well as. So it talks about intangibles also. The auditor, has to see whether the company has been maintaining proper record showing the location, quality or quantitative details and situation of the property, plant and equipment. Whether the company is showing full particulars of intangible assets, whether those assets have been physically verified by the management at regular intervals, and if there are any material discrepancies being identified, how they have been dealt in the books of accounts. So I put the comparison between 2016 to 2020. Again, if the title deeds of the company or the immovable property are not in the name of the company, then the format has been specified. Then it has to be mentioned about what is the description of the property, what is the gross carrying value, why it is not held in the name of the company, in whose name it is held, for the period for which it has been there, and reason for not holding. All these things have to be mentioned. Plus, we discussed in Schedule 3 If it is revalued, then if the valuation is more than 10% for each class of asset, it's not all of them put together. If there are multiple classes, for each class of assets, if there is a valuation, revaluation about 10%, then the fact has to be mentioned, along with the fact that whether it has been done by a registered valuer. We have already said in Schedule 3. If there are any proceedings have been initiated under or pending against Benami Property Transactions Prohibition Act, then the company has to appropriately disclose the details in financial statement. So the auditor has to do enough, take enough audit evidences here before commenting on this property, before commenting on this particular clause, whether what is the stage of those proceedings, how it has taken a turn, all these things have to be verified, and then the statement has to be made under this particular clause. Next clause, we talk about physical verification of inventory. Here again, whether the responsibility is now on the auditor to be there in the physical verification to see whether it was done, whether it was basically matching with the records, if there are variations, why there are variations. And in the case of inventory, the auditor has to say in his or her opinion whether the coverage and the procedure for such verification by the management is appropriate. And if there are discrepancies more than 10% or more, then how, whether they have been noticed, and if so, how they have been dealt, whether they have been dealt properly in the books of accounts of the company has to be mentioned. So whether during at any point in a year, the company, again, if there are working capital sanctioned in excess of 5 crores, whether the quarterly statement submitted to banks and financial statement, whether they are matching with the books of accounts of the company. If not, why and how they have been dealt has to be mentioned. So when I said early warning sign, this is an early warning sign for a reader of the financial statement. In CARO 2016, the threshold for material discrepancy was not there. In 2020, they have quantified at 10% as the threshold for, a threshold, and the auditor has to check and whether there are discrepancies to be mentioned. Again, the auditor has to verify the stock statement and see whether what is submitted to the banks is matching with the books of accounts of the company. The third point is repayment of investment guarantees, securities, loan. So if the company has made any investment or provided any guarantee or security, then to any firm, LLPs or any other thing, whether the loans have been provided, basically this need not be reported for companies. For them, lending is a basic activity. It is to be given for others. Similarly, if there are outstanding, how long they have been outstanding, what actions have been taken to recover that money. It need not be a legal notice, but what kind of activities is being taken, whether the investments made or guarantees provided or security given, the terms of conditions of the grant of all loans and guarantees are not prejudicial to the interest of the company. So if the company is borrowed at certain percentage of return, borrowing, and if it is given at a different lower than that is at the prejudicial nature of the company. So those things have to be mentioned here. In respect of loans and advances, or in the nature of loans, whether the schedule of repayment of principal and interest have been regular. So 1 or 2 months delay here and there may be considered as, or 1 or 2 days delay here and there may not be considered as irregular. If it is going to be continuously for several months, then that needs to be reported accordingly. If the amount is overdue, state the amount of overdue for more than 90 days and whether there are reasonable steps taken by the company to recover the principal and interest. So reasonable steps here need not mean I've sent a legal notice or something, or I've gone for a litigation or something. Even sending a normal advocate note for recovery or our own note to the person to recover that money could be a good enough reason to say whether it has been taken into, reasonable steps have been taken or not. Whether any loan or advance in the nature of loan which has fallen due has been, this speaks about evergreening of loans. You take one loan to repay another loan. You take one loan to repay another loan. So this is called evergreening of loans. So if the loans are repaid by taking another loan, it is a sign of some distress. It's a sign of early warning sign for the reader. So that has to be brought to the notice of the readers of the financial statement. That needs to be mentioned. Whether the company has granted any loans or advances in the nature of loans, either repayable or on demand, without specifying any terms to the promoters, directors. We just spoke about how much out of the outstanding is with the promoters and related party compared to the total outstanding. That needs to be mentioned here. There is no change with reference to compliance under 185 and 186. It continues to be the same. A huge area of audit time spending, a huge area of deep diving into data to understand this one. For acceptance of loans, it remains the same thing, not much difference. Only thing, in the new provisions of CARO 2020, even deemed deposits are covered. So whether, if the deposits are accepted by the company or amounts which are deemed to be deposits, whether the directives given by Reserve Bank of India have been fulfilled. If not, what are the contraventions, whether, the order has been passed against the company by CLB or NCLT or any of those things have to be mentioned. But otherwise, there is no much difference in this particular clause as such. The next point is on cost records. So there is no, again, change in this particular clause. It is same as the previous CARO 2016. But only thing we have to be remembering here is it is made and maintained. Whether the maintenance of cost records have been specified by the central government, and if so, whether such accounts and records have been made and maintained. Made is for the cost accounts and maintained is for the cost records. So it doesn't stop only with the cost accounts, but you have to ensure the cost records are also made and maintained. So you have to just glance through the cost records or take a report, look at the cost auditor report, apply your necessary due diligence before concluding on this particular point. Statutory dues, it remains the same. If there are any undisputed payment for more than 6 months, that needs to be reported. If there are any disputed payments, where the dispute is, what kind of litigation we are into, at what level the cases, it all has to be mentioned here. When we say it is disputed, that means an appeal or something has to be filed. A mere representation to the concerned department cannot be treated as a dispute at all. Again, the only addition from 2016 to 2020 was introduction of GST. So we are going to mention even along with GST, PF, ESIC, income tax, service tax if any, customs duty, excise duty, any value-added tax, anything, cess, and any other dues. With any other dues, even your municipal taxes could also come under the reporting. Disclosure of transactions not recorded in the books. So this is a new clause which has come from 2020. Whether any transactions which are not recorded in the books of account have been surrendered or disclosed. I said in Schedule 3, if the company has offered any income under VDIS scheme, then the fact has to be mentioned. That is what precisely you are saying. If it was not previously recorded, then it has to be mentioned. Whether it is disclosed, then the fact has to be mentioned here. Default in repayment of loans or other borrowings. Whether the company has defaulted this is a early warning sign for a reader of the financial statement. Even for me as an employee to join an organization, if I can read at the CARO report stage and see the company has defaulted in payment of so many loans and there are a lot of other red marks in CARO, then I would be thinking 2 times to join this organization or not. At least the statement is telling me so. Then I apply my discretion and my due diligence before taking any necessary decision. Whether the company has defaulted in repayment of any loans or other borrowings or in payment of any interest thereon to any lender. If so, we have to mention the period for which the default has been there, and there is a prescribed format specified. So what is the nature of borrowing, whether it is debt securities, who is the lender, what is the amount not paid, whether it is only the principal not paid or interest also not paid, how many days of delays, and any other remarks to be mentioned. And as we mentioned, if the company is declared willful defaulter, then the name has to be mentioned. So that also has to be mentioned by the auditor, whether the company has been declared as a willful defaulter by any bank or financial institution. Again, the loan taken for X purpose, used for Y purpose, that needs to be mentioned. Whether short-term funds are used for long-term purposes or vice versa needs to be reported. Whether the company has taken any funds from any entity or a person to meet obligation of its subsidiaries or associates or joint venture. If so, what are the nature of transaction needs to be mentioned. If the company has raised loan during the year on a pledge of the securities held in the subsidiaries or a JV or an associate company, then that also needs to be highlighted so that we will know that what is the exposure level of the company so that we can take appropriate decision making. Again, this is almost the same, only thing it talks about if money was raised by any IPO or a FPO or a preferential allotment or a private placement, whether now it includes convertible debenture also, whether it is used for the purpose for which it is raised. If not, the details have to be specified. Similarly, whether the company has made any preferential allotment during the year, the provisions of 42 and 62 have been fulfilled, because if you are going under a private placement, the money cannot be utilized till you file your pass 3, whether that is being done. The auditor has to check and report over there. Again, if there are any term loan taken, then that also needs to be a term loan's condition also to be seen. So the purpose of the term loan, whether it is put to use for the same purpose, needs to be mentioned. Fraud reporting was already there, but it was there only to the extent to say if there was any fraud on the company or fraud by the company or fraud on the company by its officers and employees. So if there is any fraud in the company which was not done by the officers or employees, then under the previous CARO 2016 it was not required to be reported. But under 2020, all kinds of fraud by the company or on the company has to be reported. So if there are any cyber theft, if there are any other kind of fraud which has been happened with the company or the company is done, then all of them have to be reported. Along with that, if there is, if there is any fraud is being identified above certain threshold limit, the statutory auditor of the company has to file Form ADT with the central government. So whether any such report has been filed by the statutory auditor is to be reported, and whether the auditor has considered any whistleblowers complaints, if any, during the year. This is going to be very important. We have to call for the records where we have the whistleblower cases, read all of them, and then find out how they have been closed. So whether those things have to be considered to identify is there any fraud reporting to be done by the company. So there is an expanded work for an auditor currently. So the auditor has to roll up their sleeves to find out how to grapple with these disclosure requirements. So for Nidhi company, I won't get much into that. The 1:20 net owned funds have to be reported. If there are 10% or more unencumbered term deposits are there, that all needs to be reported. Compliance with 177 and 188. So there is no change in that. It remains the same. Internal audit is something, a new one which has come. The auditor has to say whether the company has gotten, first, whether the internal audit is applicable for the company. It is applicable for all listed company, public limited company having certain threshold of turnover, capital and borrowings. Even to a private limited company, it will apply if your borrowings above 100 crores. So many times that gets missed out. So even in a private limited company, this could be applicable provided your borrowing is above certain limit. So whether the company has an internal audit system to commensurate with the size and nature of the business is to be mentioned. Whether the statutory auditor has considered the report of the internal auditor while reporting. So what happens today, if we are in a scenario, a company has got a statutory audit, internal audit, cost audit and secretarial audit. Each of the auditor has to consider the others' observations and opinion so that you get much more information as to how the organization is performing or what is going wrong or what needs to be identified by the auditor as required under the provisions of law. So we all have to supplement and complement each other's work. That is how we will be able to do a robust disclosure to the various stakeholders. if there are any non-cash transaction which was already there before, whether the company has entered into any non-cash transaction with the directors or person connected with him. If so, then we have to make whether the provisions of 192 of Companies Act has to be disclosed. Registration of Reserve Bank of India, I'll not get into this. If you have if you are doing a company which has got it's called core investing company, then whether it continues to fulfill the criterion of CAC, or in case of exempted category, whether it has been done, that needs to be under. If there are more than one CAC, then you have to indicate why there are more than one CAC, core investment company, in that group. This is a new clause, again an early warning sign for the reader of the financial statement. If the company has incurred cash losses in a financial year and in the immediately preceding financial year, the auditor has to mention the amount of cash losses. Cash loss does not mean negative cash flow in your operating cash flow statement. It is larger than that. So if there are cash loss, you have to identify the cash loss. If the cash loss is there in the current year also, in the previous year also, preceding year also, that needs to be reported accordingly. If there are any resignation by a statutory auditor during the year, the auditor has to mention whether he or she has taken into consideration the issues or the objections raised by the such outgoing auditor. This requirement was already there under SEBI. Now, Companies Act has brought it into form of CARO reporting, because when the existing auditor resigns, there could be various reasons for which they would have resigned, and the incoming auditor is supposed to take that into consideration so that he or she is in a position to report it better to the reader of the financial statement. This clause is a new clause and it wants a lot of subjective statement. When I say subjective statement, the clause says on the basis of the financial ratios, which is there in your Schedule 3, on the aging analysis, which is there again in your financial statement, and the expected dates of realization of financial assets and payments of financial liabilities, and any other information in the financial statement, and the auditor's knowledge of the board of directors, management plans, whether auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that the company is capable of meeting its liabilities existing at the balance sheet as and when they fall due within the next period of 1 year. So that means, as an auditor, I have to look at the ratios, I have to look at the aging analysis, I should look at the management's projections, I have to look at the management business plans, I have to understand the director psychology also, the way they have been running the business, taking into consideration all of them and looking at the cash inflows and outflows schedule, whether, in my opinion, when the liability occurs in the next 1 year, will the company be able to pay? So, but this statement is given as on the day we are reporting. If things go wrong opposed to this, then as an auditor, you and me will not be responsible. As on the date, so that means we need to have a lot of audit working papers before we comment on this particular clause of financial statement. It is going to be a Herculean task, but the working papers and the rationale how we have decided is what is going to help us in case tomorrow we have to explain this to any authorities as such. The next one is, if there are, I said CSR is a huge area of practice, huge area of responsibility available. So whether the company, whether if there are any ongoing projects, we have to say whether the company has transferred the unspent amount to the fund, which is mentioned under Schedule 7 of the Companies Act, that to be mentioned transferred within 6 months from the end of the financial year. If not, that needs to be mentioned. Similarly, if there are any unspent amount remaining pursuant to an ongoing project, it has to be transferred to a special account. It cannot kept in the current account. So if it is not done, then those things have to be reported separately. Managerial remuneration, this clause is omitted. Previously, it was available. Now, this has become a part of the secretarial audit report, and hence this is not. This has been dropped from CARO report. As I mentioned, the last point of CARO report is if there are any unfavorable or qualified opinion by any of the audit reports which are considered for consolidation, the consolidation auditor has to bring in those qualifications or unfavorable opinion and put it on the main CARO report without applying any materiality threshold. That's it. They have to just copy paste that saying that in so and so subsidiary or so and so entity in the CARO report under so and so clause, this is the qualification and this is reproduced for your reference. That is what is to be reported specifically. This is as far as CARO 2020 is concerned. If there are any questions, I would be happy to take, and then we discuss some of the adjudication orders which are really worrisome, bothersome for professionals, be it any kind of profession, whether you're a company secretary or a chartered accountant or a cost accountant, it doesn't matter, or a legal professional. The kind of adjudication orders we are seeing is of real worrisome for the professionals. So company law compliances have to be taken extremely serious. If there are any lapses on that, it is going to be a costly affair, like, missing anything in your income tax or in your GST returns. So one of the adjudication order we have seen is non-appointment of company secretary. A company is, and the two of the directors were levied penalty for 777 days of delay in case of Nandi Infrastructure Corridor Enterprises Limited, and in case of Atlas Logistic Private Limited, for the same non-appointment of company secretary, the Bangalore ROC has levied 48.68 lakhs of penalty for non-appointment of company secretary. Yes, some of these cases have traveled from ROC to RD, and they have reduced the penalty. But having said that, they have ensured that the penalty is being levied, and it is not a small sum of money. This is the case for not appointment of a KMP. So there is a delay, penalty is levied on the company, then on the number of directors who have been in that company. So accordingly, in this case, look at the kind of penalty which is being levied under Smith Detection Systems Private Limited. On the company, 5 lakhs, on all of the directors, because 5 lakhs is the maximum. So depending on the number of days, 1,000 rupees per day for 406 days, they have calculated as 4,06,000 plus a fixed penalty of 50,000. So it is 456. Had the number of days gone to 450, then it would have gone up to 450 and stood at the maximum penalty of 450. It is just not on the company, it is on number of directors. So assume you have 4 directors, it is company's 5 lakhs plus 4 directors 5 lakhs. We are talking about 25 lakhs of penalty we are talking about. Next is the question on basically what is this? This one is on, again, company secretary. I am not linked to that. This is a very interesting adjudication order to be read. In Embassy Infrastructure, Infratech India Limited, ROC of Jaipur has, what was the facts of the matter? That a company, I just told you in the beginning, company sent, the ROC sent a letter to the company. It returned back. Then the ROC officials visited the registered office and found that the company was non-existent. Based on that, they sent a show cause notice and the adjudication formality started. What are the sections under which they have levied penalty? If you were to have a registered office, you didn't have it. That is one section under which there is a violation. Plus, if there is no registered office, how you would have maintained your accounts or the records in the registered office. So there is a violation under section 12A. Similarly, your books of account and minutes books have to be maintained at registered office. They are also not maintained. The register of contracts, the register of arrangement in which directors are interested, they are also supposed to be maintained at the registered office. Even that is also not maintained. Plus, the company had not filed their annual financial statement and annual returns. So again, 2 more sections. End of the day, put all of them put together, it was some 40-50 lakhs of penalty levied on the company. Maybe the RD would have be leniently reduced it. But having said that, the order from Registrar of Companies Jaipur was a solid 40-50 lakh rupee penalty notice. Next is in case of Sita Industries. very, very interesting case for each of us to understand. If there is any, under the board's report, the company is supposed to report whether the company has complied with the provisions of POSH Act, right? That was not mentioned in their board's report. The matter went for adjudication and they have levied penalty of 3 lakh rupees on the company because director's report is supposed to contain certain information. If we fail to put those information and the matter goes for adjudication, the penalty will be levied. So it was levied on the company for 3 lakhs and on the managing director because there was a KMP on the KMP and on the company secretary 50,000 for a simple matter of not reporting a POSH or compliance in the board's report. Penalty of 4.5 lakh rupees was levied on the company and the promoters. There is a question on the chat box. Let me take that. What are the provisions regards to manufacturing industry, which is also involved in investment in equity shares through AMS, PMS, direct equities, debt instrument, which an auditor should take care while reporting? Also, are there any restrictions in Companies Act which restrict company in making such investment where income is substantially around 30-40% as compared to profits from manufacturing activity? Sir, if you have to remember, I just said CIC, core investment company. If your income from your investment is more than 50%, or if your assets investment is more than 50% in your financial assets, then you have to do the core investment company regulation. You have to take the RBI registration and do that. What necessary precautions to be taken? The auditor has to calculate the rates and find out and see whether you are fitting into CIC requirements and then do necessary compliances. For a private limited company, whether all schedule of financial statement to be given in the financials, even though it is not applicable for X long-term liability and intangible assets. Sir, I'm not sure what is your question. For a private limited company, whether all schedule of financial statements to be given in financials, even though it is not applicable for X long-term liability and intangible assets. Can you
would you like the question to be elaborated, ma'am?
Yes, yes, please. Yeah.
Yeah. So I request Girish Kumarji to please either write it in more descriptive way in the chat or please unmute yourself.
Sir, one more point I mentioned in the beginning, saying that the latest adjudication order, which is circulating in your WhatsApp in the last 1 week or 3 or 4 days, is there has to be a reporting of any expenditure which is more than 1% or 1 lakh rupee, whichever is higher. The details have to be provided. If it is not provided, in this case, they have levied penalty on the statutory auditor. We don't know about the status of the company, but an order has been passed on the auditor saying that there is no mention of the same from the what do you call? From the auditor, any reporting on that. That is also there.
So Girish ji is
Hello.
available. Yes,
Hello.
Girish ji, please.
Hi, ma'am. Good evening, ma'am.
Good evening, sir.
Ma'am, in case of a private limited company, so when we give a balance sheet in P&L as per Schedule 3,
yes.
So we need to mention like in equities and liabilities, shareholder funds, non-current liability, current liability.
Yes.
Then non-current assets and current assets.
Yes.
And after there are many things will come now.
Yes.
So let's say in case of long-term liabilities, I don't have long-term borrowing, I don't have other long-term provision. Still, I have to give a schedule of everything in my financial.
The schedule is not required if there are no information. Only if there is an information, you might need to give the breakup. If there is no data there is no need for a schedule over there. That is for sure.
And not in face also, I need not to give any schedule.
Sir, I take a opinion. I will put it on the face of it so that the reader of the see. Even the Schedule 3 amendments where certain information are there, people are reporting only few things. I report all of them saying that, tomorrow it should not appear that I've said nothing is applicable. So, so put it at nil there would be a better way to put it in my opinion. But there are people who don't put it because if there is no information, that means it is not there. That is another way to look at it.
And one more thing, ma'am. So can the company and director sign the financials with the digital signature?
It says so, but in fact, I would give you an example, instance. I was in Goa for a seminar a month ago. One of the professional did mention to me that we put it SD and uploaded, and they have got a notice. SD, I've been saying from very beginning that SD is not the way to upload a financial statement. The statements have to be physically signed. If it is digitally signed, my only challenge is when it is signed and it is uploaded, I can verify the signature, right?
Yeah.
But you're going to upload a scanned copy.
Yeah.
So how do I verify? So my suggestion is maybe for the purpose of adoption in the board, you can take it, but to upload it in MCA portal, physical signature would be a better idea.
Okay. Thank you, ma'am. Thank you. Thanks a lot.
Yeah. In case of lorem rail, maintenance, conducting of 4 board meetings. In case of a normal company, 4 meetings. In case of a small company, 2 meetings in a year for every half year. Yes, Asha Sharma is saying, I think Schedule 3 is not rigid. We can remove nil, not applicable. Yes, I do agree with you. Yes, that's what I said. So in case of lorem, for not having a board meeting, because the gap between 2 meetings should not be more than 120 days. If it is there, in this case, penalty was levied. And now we've been doing for a very long time. Those board meeting details are also being captured in your director's report and in your MGT 7A. So we have to ensure that number of meetings are being regularly conducted and they are being taken into consideration. I've just looked at the last few adjudication orders last night. I just picked up the recent ones to give you the seriousness of the situation. In case of Utkal Chamber of Commerce and Industry Limited, they said the name of the company, there was an advertisement in a newspaper wherein, it was published along with another industry association. In the name of the company was not mentioned as Utkal Chamber of Commerce and Industry Limited. The word limited was not there in the paper. So the objection was raised and it went for adjudication. And the company said, I didn't have control over the data because I never published that advertisement, nor I paid for it. They went back and proved all those things, saying that, it was published without my knowledge and it was an honest error. And they had dropped that penalty. It was supposed to be levied, but they levied. What I'm trying to say, the smallest of error which was done even in our, without our knowledge, is all being challenged. If things go right, everything goes right. If anything goes wrong, there are a lot many things to come and hurt us. That is where is our problem. Similarly, in case of Gagan Narang Sports Promotion Foundation, minutes of the meeting, there was an inspection in that process. The minutes of the meetings were not consequently numbered. So they will levy the penalty, because if you are not numbering them consequently, anything can be inserted as a post thought activity. So it has to be consequently numbered. It was not numbered. Penalty was levied. In case of Mark Mercantile Private Limited, penalties were levied on the auditors. I just told you, for not disclosing the details of loans and advances, not disclosing expenses above 1% or 1 lakh, whatever is the higher limit. Similarly, in case of Pioneer Pollution Control and Air System, non-submission of proof of serving a notice for a board meeting. This is the most taken for granted provision. I tell my director he's coming attending. Tomorrow something goes wrong, the matter goes, we don't have a proof of serving notice to the director. There the penalty was levied. If I say Drishti Development and Communication, here the company has voluntarily gone for adjudication. There was a pass 3 for allotment of shares being filed. At the attachment, the form, they have said 8 crores 86 lakhs 6,610. Actually, the number should have mentioned is 8 crores 86 lakhs 6,800. They have gone voluntarily and got it adjudicated. They said the professional signing the form and the director who has signed that form, both are held guilty for not verifying and levied a penalty of 10,000 rupees on each of them. The purpose of the entire discussion here today is many a times we don't do, intentional fraud. We don't do intentional wrong, but those unintentional, accidental lapses, human error are also being punished stringently, and that is where is my concern. Okay. In case of a proprietorship, company is now being recasted into a limited company and going for SME IPO with the last 3 years account need to be restated in Schedule 3 format. What are the provisions which are applicable for reporting? All the entire Schedule 3 is applicable, sir. There is no what do you call, waiver given. Schedule 3 requirement applies to each and every company. No, that is where is the problem for SME. You don't have a what do you call, waiver for non-disclosure. Yes, you will get the PPT of today's webinar. If there are any questions, I'll be happy to take. With this, I conclude my session. I thank GyaanStation, Dipti ji, and the chairman of Chhatrapati Sambhaji Maharaj chapter chairperson, and the president of tax income tax association people, all of you, for giving me an opportunity. Thank you everyone for the patient hearing. It's indeed my pleasure and my honor to be with you all today. Thank you so much.
Thank you, ma'am, for this wonderful
Okay, there's
deliberation.
one last question. Somebody
Yes,
is asking
can you
me, can we
stop
do it with
sharing
zero
this?
capital? This is
Yeah.
something I wanted to say, everybody. When a company is incorporated, you have your, what do you call, subscribers to the memorandum who have said they are going to be, what do you call, subscribing to the shares, right? So within 60 days of incorporation, whether money comes in or not, the capital is already there. And if the capital does not come in cash, you will create the capital and keep a receivable of whatever is the capital to be recovered. Assume for a moment, if the subscriber says, I will not pay it, the company can take necessary action to recover that capital from the subscriber, because that is a contract and they cannot go out of it. So the capital will be there from day one, irrespective of whether the cash is received or not. The subscribed amount of capital is very much there in the share capital of the company. It cannot be zero at any point in time.
Thank you, ma'am, for sharing your views. And it was really wonderful session and very helpful, as also the need for every professional practicing. We need to work on all these points. And we have received wonderful feedback from all our participants. And the question is whether you can watch the recording of this session on our YouTube channel, GyaanStation. So please do subscribe to the YouTube channel. And for all the upcoming webinars, you please join our WhatsApp community. There you will get the information for all the upcoming webinars of GyaanStation. The link is shared in the chat box. Also, I have shared the link for our 29th program that will be conducted on 29th of February, that is again Thursday, on the topic intricacies involved in section 43BH with respect to delayed payment and other relevant issues under Income Tax Act. Again, a very burning topic. Lot many sessions has been conducted are being conducted on this, and the speaker is going to be CA Abhishek Jain. He is income tax expert from Delhi. From Delhi, he is joining GyaanStation on 29th, Thursday, from same time, 4 to 5:30. And I would like to launch a poll, as well as I request Meenakshi Gupta ma'am. She has joined us to please share her views. Over to you, Meenakshi ji, please. Yeah, please, you can.
Thank you, Deepti. I am unable to unlock my video, so I will just, okay, I think it is there. Thank you,
you
Dipti.
can.
It was a great session. I know Rangachari madam from a long time. I have been meeting her in various seminars. She is a regular attendee of so many seminars in ICAI. And it was a wonderful coverage by her of Schedule 3 amendments and CARO 2020. And specifically, the way she has touched upon the various clauses, various penalty which has been imposed by MC, ROC, and various authorities. It will be an eye opener for all the professionals, because so many things we as professionals also take for granted. So if we as professionals take for granted, you can very well understand how the companies will take more than granted. So
Right.
it is a very big eye opener. I'm sure professionals will be benefited, and I personally attended this session because the more you listen, the more you learn. So there is never an ending to the learning process, and you are doing a wonderful job by way of GyaanStation. Congratulations and all the best.
Thank you so much, Meenakshi ma'am. There's last query, and
Yes.
Pragya Jain can unmute herself. So it will be.
Dipti, before there is only one question somebody is asking.
Yeah, that's what I'm
AGM is
asking.
not conducted on due date, then can auditor sign the balance sheet on later date? What is the liability on the auditor? See, as an auditor, whenever the financial statement comes to you, that's the time you will sign it. But the only challenge is if the company do not conduct, the AGM in time, they should have gone for the extension well before 30th September. You can't go after that. So if the company is able to get the 3 months extension maximum, that's what we get it. If they are able to get it, then we have no problem. Assume for a moment the company does not get the extension. We have nothing to do. As an auditor, we can sign only when it comes to us. The heat is on the company, not on us. Yeah.
So we have also launched a poll for the participants' feedback, and thank you.
Thank you very much.
I expect the participant to please share their views, because it's going to be very helpful for us to improve ourselves for all the upcoming webinars. Quickly, next 2-3 seconds. And ma'am, please, you can go through all the comments in the comment box.
It's my pleasure. It's my pleasure. Thank you. Knowledge sharing is the only thing we can do in our profession,
Right. So it's excellent. We have received the poll result, and it's the best. The session covers everything, and the day and time is good for all our professionals to attend it. Thank you. So here are the poll results. Thank you all for joining, and again 29th फिर मिलते हैं Thursday को same time 4 to 5:30. And Rama ma'am, thank you so much for an insightful, excellent, superb session, doing all justice to the topic. And I know very well that all the participants are very much happy and satisfied, and you were able to fulfill the more than expectations. You reached beyond expectations. So I would like to have you more on GyaanStation and come up with more insightful topics for all of us.
It'd be my pleasure and honor. Thank you.
Thank you all the participants for staying with us, always motivating us, and keep spreading knowledge, keep spreading the message, and stay tuned with GyaanStation. Thank you. Here we end our